Hello, my name is Tiziana Ventimiglia and I'm the branch manager for RGS in Reston. Tax time is here, April is fast approaching, and I know that many of you are touching base with those clients who purchased or sold in 2008 and you're providing them with another copy of the HUD-1. So everyone asks, what is deductible? Hey, time out for the disclaimer.
This brief message comes with a disclaimer that your clients should consult a tax attorney, a CPA, or the IRS and not rely solely on T's words, which are intended to provide general information only.
Got that? No, really got that, right? As we all know, each client has a specific financial situation and they all warrant detailed professional attention. If your client sold a primary residence in 2008, normally speaking, the interest paid up until the payoff date is deductible. And so are the taxes, the real estate taxes, which are paraded on the front page of the HUD-1. You should direct your client to read IRS Publication 523. Currently, taxpayers don't pay taxes on the gains as long as the gains are $250,000 or less for unmarried individuals or $500,000 for married couples who normally file a joint tax returns. And of course, there are several prongs of the test. These must have been their primary residence, they must have owned it for at least 2 of the past 5 years, and they cannot have used it during those 2 years as an investment property. The first thing to determine is the amount realized, which is determined by the difference between the selling price and the selling expenses. The second step is to subtract from the amount realized the adjusted basis of the property. This will give you the amount of gains realized. So what is it that reduces the amount realized? The selling expenses, your attorney's fees, the commission paid at closing, if there are any points that the sellers have paid on behalf of the borrowers, the grantor's transfer tax. Now in 2008, we have certainly seen a spike in short sales. Short sales are a handful. As we know, short sales occur when a lender or multiple lenders agree to take less than the amount owed on the note. If that is the case, those lenders will most likely issue a 1099-C, and the taxpayer may end up having to pay taxes on the debt that was canceled. Your clients should be directed to IRS Publication 4681 and should certainly become familiar with the Home Mortgage Forgiveness Act. The prospect of having to pay taxes on the forgiven debt might be overwhelming. Not all hope is lost though, if the debt is quote-unquote a qualifying debt. In other words, the borrower used the property as their primary residence, the borrower did not file for bankruptcy, and the forgiveness was not really intended as a gift. Things are a lot more complicated if the short sale involved not a purchase money deed of trust but a refinance. Then the question becomes, was it a straight refinance or was it a cash out refinance? If it was a cash out refinance, then the borrower may need to prove that they are insolvent. And they will do this by using tax form 982 and attaching a 2-column worksheet showing their money in and their money out up to the date of sale. Well, how about the buyers? What is deductible for them? The IRS publication in question is number 530. Well, clearly everybody knows about the interest that is paid. The lender will send at the end of the year a document that is called the 1098. One thing to remember though is that most lenders will collect interest up front for the month that the home is purchased. So your client may need to do a little bit of math to figure out if the 1098 included the prepaid interest or not. Certainly taxes that are paid are deductible, and possibly even points and discount fees that are paid on the HUD-1. Since 2007, the amount paid for private mortgage insurance is also deductible up to a certain extent. There is a lot of limitations, especially when it comes to income that exceeds $100,000. Also, if your clients were first-time home buyers, they might be eligible for a one-time credit of $7,500 as long as they purchase the property between April 2008 and the end of the year. Keep in mind, however, that there might be restrictions here as well based on income. What about all of the other fees itemized on the HUD-1? Those fees might not be deductible, but they might raise the basis of the home. For example, the attorney's fees, the cost of the title insurance, the title examination, even surveys. So this will come in handy when your clients are then ready to sell the house. There is so much to read. Those publications from the IRS will be very helpful, and your clients will be very prepared for tax season.